The way I think about it, though, is the same for everyone. It's storytelling. It's got to be real, so it's not fairy tales, but it's storytelling. People resonate to stories. It's nice to say that people are data-driven and this and that, but ultimately what resonates and what's memorable with an investor is a compelling story.
What is going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Andrew Jeffery, who has an extensive career in the real estate business. And he's had his hands in multiple different components of the business as well. Kind of the highlight of Andrew's story is that he started on a trading desk in the mid-2000s at a firm in Manhattan and experienced the GFC literally firsthand. Saw everything from '07 to 2009 post-crash, and we talk a lot about that in this episode. I get his whole take on what's going on today in the marketplace, how it compares to what happened in '08, given that he had literally a firsthand view of the whole development of the subprime mortgage crisis. And he also had extensive experience as well, working with foreclosures, brokering foreclosure homes in the San Francisco Bay Area. Him and some partners started their real estate firm back in 2010, looking for small to mid-sized multifamily properties in San Francisco, and subsequently built a portfolio coming out of the GFC. And we spent a lot of time talking about his viewpoints on leverage, and again, how he views what's happening in the market today comparatively to what happened in 2008 and shortly after the great financial crisis. So a lot of great current events topics from somebody who is extremely adept at just the dynamics at play today comparatively to then. We also talk about how he's grown his business over the last 10, 15 years, and specifically what he does on the acquisition side. And his career took a pivot back in the 2018 timeframe where he basically became an outsourced head of acquisitions for a lot of larger firms, most prominently a Swiss REIT, where he was flying around the Sun Belt and actually looking at deals on their behalf and helping them build their portfolio of multifamily throughout the United States. So he has extensive experience underwriting very large institutional quality multifamily deals. And I get his whole take on, how he quickly underwrites deals, what he looks for in an OM and a pitch deck, how he pitches deals to investors as well, because he has a lot of experience on the capital raising side in addition to the acquisition side. We also spend some time talking about the nuances of investing in a rent control market like San Francisco, which I think is just an interesting topic of conversation, even if you're a listener out there who is not investing in a market like that. We spend a lot of time talking about how they view the current tenant situations at a property while they're going through diligence and underwriting. And I think there's a lot that really any investor can take away from that component of this episode and interview, even if you're not buying rent control properties. Just how he views the whole process of turning over a building, I think is going to be applicable regardless of what market you're investing in. And a lot of what he shares is relevant regardless of your strategy and where you're actually buying deals. So long story short, this is a great episode start to finish. And Andrew is an extremely intelligent real estate investor, somebody with 15, 20 plus years of experience who has seen multiple cycles, and is someone who is just operating at a really high level and just discusses his thoughts and opinions in a very eloquent fashion. So really looking forward to releasing this episode. And if you do enjoy this episode, please consider leaving the podcast a rating and review. And as always, thank you all for listening to the show. Let's get to this episode with Andrew Jeffery. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Andrew Jeffery. And if you listened to the intro here and you didn't just skip past it, but you listened to it, you probably heard me talking all about Andrew's background in acquisitions, in a bunch of different product types and a few different markets as well, working with different sponsors. Really just a lengthy track record as it relates to his experience in the real estate sector, and then also specifically in acquisitions, which we're going to talk about in this episode. But we're going to start with Andrew's story. So Andrew, first of all, how are you doing? And second of all, let's learn a little bit more about where you came from and how you got into this real estate game.
Sure, Axel, thanks a lot. Appreciate you having me on. It's good to be here. So I think like a lot of people, I would describe my entry into the real estate investment space as stumbling in. It was not the plan from the beginning. To make a somewhat long story short, my first job out of college, when I moved from California to New York, was in sort of an obscure corner of the mortgage finance space in 2001. And that ended up leading me to, a few years later, sitting on a subprime mortgage-backed securities desk to watch the subprime fiasco kind of go all the way up and all the way down. So it was a super interesting, formative place for me to be. So on that desk, I was working with another guy from California who grew up near San Francisco as well. And as the market started to turn in 06, 07, and we saw the writing on the wall, we said, you know what, there's going to be opportunity on the other side of this. We didn't have actual direct real estate investing experience, but we figured, hey, you know what, we'll figure it out. So we road trip back across the country and, did the California thing, started in a garage with one other guy. And 2008, 2009 was just surviving. We were definitely not investing in real estate despite our efforts. I mean, if you were in the business back then, I mean, everything was stopped. The world was grinding to a halt. And we were just, like I said, doing what we could to survive. We used our old contacts back from New York. We signed up big hedge fund, private equity clients, and small ones who were buying distressed loans at the time. We valued properties. We were valuing, hundreds and even thousands of properties in any given week all over the country, evaluating loan tapes, and all the while trying to raise money to actually buy real estate. I mean, we saw what was going on, and we just had no track record, and no one would back us at the time. Finally, around 2010, we did our first deal. It was a small 8-unit building in San Francisco, and from there, we just sort of ground our way up. The next deal was a little bit bigger, We partnered with some older guys, and we did a small discretionary fund in 2012, all multifamily in San Francisco. And then as the San Francisco market got hot and sort of, in our view, peaked out in sort of 2016, we switched product types. Still in San Francisco, we did a little office, we did a little industrial, a little retail. And then at that point, sort of my career trajectory changed. I left my original partnership and went from being a general partner and decision maker to more of a service provider. I have this, kind of small niche market at this point where I'm effectively an outsourced director of acquisitions. In 2017, 18, I did that for basically the equivalent of a Swiss REIT that was buying all over the country. So I, flew around to your standard Sunbelt markets, Phoenix, up to Seattle, Portland. And that was great, actually. I got to see parts of the country I'd never been to. I had a great time in Cincinnati, for example, and just, got to see a different side of multifamily that I hadn't seen before. And then, COVID obviously, put a wrench in all sorts of different markets. San Francisco market basically shut down. And so since then, I've been back to sort of my roots doing San Francisco multifamily, and I'm working with a small group right now who is trying to pick up pieces in San Francisco. And again, sort of back to what I'm used to, underwriting San Francisco multifamily deals.
Love it. No, I mean, it's an incredibly diverse set of experiences. And I have to imagine that coming out of '08, being on a desk where you're watching a lot of these products kind of unravel has to affect how you view risk and decision making, at least early on when you started buying. You mentioned you started with an 8-unit, you were buying some small, mid-sized multifamily in the Bay Area in San Francisco. I'm just out of curiosity, like, what was your opinion of leverage like at that time? I mean, I have to imagine the perception of going out there and sourcing debt was somewhat skewed just based on that life experience and that career experience that most people probably didn't have. But early on, let's call it the early 2010s when you were starting to grow the portfolio in San Francisco, how did you guys view leverage? Was there a concern there between you and your business partner? And did that affect your business strategy at all?
Yeah, absolutely. No, it's a really good point. I mean, I always say that I was scarred by those experiences, and fortunately, financially, I didn't have enough to really lose anything, and so financially, I was okay. I wasn't able to save up much either, and so that was a bit of a problem starting off. But in terms of leverage, we always took an extremely conservative approach. Whether it was 60% or below LTV, maybe 65, whatever was available, we always took it back down. Now, at the time, banks adjusted, the market adjusted, prices adjusted. And so we probably didn't do as well on our early deals by taking that lower leverage. If we had levered up a bit more, we'd been more aggressive on cash out refinances, all the things that people usually do. But we stuck to our guns, and we certainly lost out on deals because we weren't willing to underwrite high enough leverage. And it was frustrating. 2011, 2012, it got super competitive in San Francisco, and we were going up against guys who were backed by Wall Street at that point, and they just had cheaper cost of capital, and they would be more aggressive, and we lost out. Now, I will say that for the deals we did in 2014, 15, we're still very thankful that we did use that low leverage, because we haven't given any buildings back, even though we were buying the same product type, same locations that the big guys in San Francisco have lost. I mean, they've lost, thousands of units, given them back. And a lot of that is because we always were conservative on that debt. And I don't think that'll ever change for me.
Yeah, it's interesting because, and I'm trying to think of the best way to ask this question, but you're perfectly positioned to share your thoughts on it, where there's just competing incentives as it relates to, if you're a sponsor, you want to put deals together, raise capital, offer compelling risk-adjusted returns, but do so in a way to where you maximize, or I should say, you minimize the downside risk to your investors, right? Which one of the easiest ways to do so, and there's numerous ways to do that, but one of the easiest ways to do so is to use less leverage. But you have the competing incentive of, we want to maximize returns, which oftentimes is a little easier to do when you use more leverage, so that we can build a really good-looking track record to make it easier to raise money in the future. And I feel like a lot of newer sponsors or folks that get into this business of raising capital and putting together deals, it's a devil on one shoulder and an angel on the other, and you're trying to manage these two expectations. And I have to imagine that you are in a unique position where obviously you're scarred by the idea of using significant leverage by watching what happened in the depths of the GFC, but then also between 2015 and recently in the San Francisco market, which is kind of a unique market relative to the rest of the country and what's happened there. How do you manage that dynamic now when you're underwriting deals and putting deals together? Maybe it's finding different investors, or maybe it's messaging the opportunity differently. But assuming that you're not maxing out and using a lot of or max leverage, however that's defined, how do you kind of manage those competing dynamics, if that makes sense?
Sure. It's a challenge. I mean, there's no two ways about it. For better or worse, what we sell as real estate sponsors is return. Now, it's more complicated than that, and we'd all like to think that we sell, the old cliche of risk-adjusted return. Yeah. But in my experience, the first part of that statement is almost always ignored. People, they can look at two deals that are, a 15 on paper, and if you try to tell them, yeah, but this is a lower risk 15, it doesn't matter. They're like, well, we'll make this one a 16 and I'll do that one. And so it's just one of those unfortunate factors that we're out there competing against people who are more than happy to juice the model and do what it takes to get a higher return, whether it's, again, layer on preferred equity or whatever structure they want to come up with. It doesn't change the fundamentals of the deal. I mean, what we always did, we said, look, we are new sponsors and the only thing we have is our reputation. That's all we got. And so everything from, we can't have a deal go sideways, we can't have a deal go blow up, to in an investor meeting, and if someone says, hey, talk to me about why you're using 75% debt, or you're going to refi at 75% debt, tell me what has to happen for this not to work out. I want to be able to have a good answer to that question. I don't want to be a young new sponsor and say, well, as it turns out, if I miss my rent estimate by 5%, like, the deal doesn't work. I mean, that it's just, maybe I can trick a few LPs into investing that won't ask that question, but that's not going to take me very far. So I think we just always took the long view, and that's still my view, is that what you have in this business is your track record. And sure, like, you're kind of allowed to have a bad deal now and then, but if you're consistently underwriting over aggressive, over leveraged deals, you're not going to have the smart LPs. You're not going to have the LPs that you want. And the other thing that I learned is that, and this is a sort of a saying, I may have borrowed it from somebody, I say, look, some capital is just too expensive. And what I mean by that is, if you have a bunch of investors who are only investing because of the return, they don't really know you, they don't really know the market, they just saw a flashy return, they're going to be the ones who are responding to every quarterly report. They're going to be nitpicking every detail. They're going to be asking a lot of questions, which, look, LPs want to ask questions, totally fine. But those investors who are only after return are probably not worth the time. And if something does happen to go sideways, they're the ones who are going to be less likely to be understanding that, you're in a tough spot and you're still trying to do everything you can to get out of it.
Yeah, no, 100%. And I think fundamentally speaking too, like, regardless of who your investor is, I mean, even if they're smaller or larger, however we're going to define that, a small retail 50, 100K check writer, or somebody who's writing a $500,000 $1 million check, they are so much more concerned with not losing their money than maximizing their returns, fundamentally speaking. Real estate is not, the tail end of a deal so rarely produces those big 3-5x returns to compensate for the risk of losing capital, that it's just much, we should be concerned with just not losing money first and foremost, and that should be the vast majority of the objective. And then if we can maximize returns through other mechanisms, that's great. But it should come back to that being the fundamental objective when you're putting a deal together and structuring the debt specifically. Let's talk about acquisitions. And I specifically almost want to jump to the segment of your story where you were going around, flying around the Sun Belt, basically working as an outsourced director of acquisitions for that REIT that you mentioned. Just at a high level, because I think this is a question that is one that a lot of people listening would like to have answered, whether they are an LP, and they're opening a passive investment opportunity from some kind of a sponsor, whether a sponsor opening up an OM from a broker who's marketing a deal for sale. When you receive an OM, let's say from a broker, right? You're looking at this new opportunity. You're going to go out there and underwrite it. You open up the package. Where do you typically go right away? Like, where do your eyes go? What are you trying to figure out quickly? What is the process mentally when you're just starting the underwriting process for a new opportunity?
Sure. So I would answer that question in two ways. The first way I would answer is that what you look at when you open the OM starts a long time before you actually get the OM. And what I mean by that is whether you're a GP, whether you're an institution, whether you're an individual, you need to have a box. Like, you need to understand what it is that you're looking for. And you can say, okay, I'm looking for multifamily in these 5 states. Okay, that's a box, but it's pretty wide. Okay, and then you can narrow it down and say, okay, I want a certain vintage, or I want a certain MSA size, or whatever. There's a bunch of different ways. I want value add, I want stabilized. There's a lot of different ways to refine that box. But the better refined and the better defined that box is before you get a single deal will make what you look at a lot more valuable. Because, for example, that particular client that I was working for had a really specific box. They wanted nothing older than 1980s. They wanted tertiary markets, had to be a 6 cap going in, 1 to 300 units. And it was very Swiss. Like, it was very precise. If it was 310 units, kick it out. So that made my job easy, because I could say, okay, how many units are it? Like, we got to know the markets. And so it wasn't all that hard to figure out if an OM is worth paying attention to. The wider your box is, the harder that initial screen is going to be. And I think that probably of all of the parts of acquisitions that are more art than science, knowing how to filter and screen and knowing how to allocate your time is probably the hardest. Because you get a deal and you're a deal junkie. I mean, anyone who's listening to this or involved in this business is a deal junkie to some extent. And so you're going to get a deal and you're going to find something to like about it. But it's that discipline of saying, nope, you know what? This is not me. This is my client, or this is my firm. I know what we need, and now I can go in. And then I would describe the way I go into a deck or an OM a little bit like the way they describe that you're supposed to do a crossword puzzle. And you have to run with this analogy because I've never actually made it before. But when you ask me the question, it's there.
I'm excited.
So I can get through about Tuesday, maybe half of Wednesday in the New York Times crossword puzzle. So I'm not a guru by any stretch, but what you're supposed to do in a crossword puzzle apparently is sort of let your eyes kind of wander over the thing and see what comes to your attention. Okay, here's a blank. That's an easy one. Oh, here's a word in Spanish. I speak Spanish, no problem. And you sort of fill in the easy ones, and then you start working on the little segments that you've already got started to make your job easier. And I looking at an OM the same way. For me, I have a couple of metrics. I'm a really big believer in back of the envelope. I mean, if I could get through the rest of my life never running a pro forma, I would. But you got to do it, right? And so then what you do is say, okay, given my box, what are my metrics? For example, when I was working for the Swiss company, it was pretty straightforward. And I always kind of am loath to give out these details that most people know if you're in the business, but it sounds too easy. If you are going to buy a property and they're asking $120 a door, and you can get $1,200 a month, so 10 times rent in that market, it's probably around a 6 cap, maybe give or take 25 basis points. So there's these little metrics like that make your job unbelievably easier. So if you're in Tucson and you get a thing that's saying, hey, look, we're selling it $120 a door and rents are $800, it's not that it's not worth it, but it certainly is going to go down the priority list. So whatever that metric happens to be for you, some people like per door, other product types, it's per foot. There's other ways to sort of come up with those metrics. Sometimes I actually love GRM, gross rent multiplier. I think it's much more straightforward than cap rate. Cap rate is so easy to manipulate that GRM is one that's just super clean. It's like, hey, it's got to be, below 10. Perfect. So that would be the next step, is come up with those 2 or 3 really high level metrics that you can use to then start kicking out deals that don't fit. And then you say, okay, now, I've got these 10 OMs that have come in the last few days. I'm down to 3 because, I didn't completely throw the other ones away, but I put them down the priority list on however I'm tracking it. Then you can actually start going into the details. And I guess what I'm looking for now, I'm like further along in the crossword puzzle. I'm looking for what I would describe hidden value. So I'm just sort of reading the way the broker is describing it and saying, okay, is the broker, for example, doing a good job of calling out all of the ways you could add value? Are they saying, hey, here's the lift you can get on this unit. Hey, this is an up and coming market. Are they doing basically a good job in describing the different ways, elements of value of the deal? Because if they are, everybody else is saying the same thing. But for example, if they leave out, if there's an Amazon fulfillment, now this is maybe dating me because I was doing this in 2018, 19. If there's an Amazon fulfillment center coming in, a mile away, and I know that, and it's not in the OM, okay, maybe there's a little element of value that I know about that my competitor might know, not. And so I'll go through and I'll, same thing on rents. If I happen to notice, hey, wow, they're underwriting, they're suggesting you can get $900 a month for these 1 bedrooms. And I know that we own an asset, in the same submarket and we're getting 1,050. Okay, maybe that's a little, checkbox. Okay. And so it's sort of, as you go through these deals that seem more interesting, just kind of naturally float to the top. And so that's the process. It's a little bit iterative. Again, I haven't touched a spreadsheet. I haven't run a number at all. Then you get down to, okay, what's, for example, cap rate obviously is important despite it being a, pretty flawed metric in my view. But look, you got to look again, what everybody else is seeing. Okay. I'm looking at everybody else is seeing, but hey, I know these expense numbers are way too low. And so this is not a real cap rate. And so you sort of in your mind separate what the market or what your average investor would be looking at going through the OM. And then you have sort of a T account of things that are, you think maybe better or worse. And then you get to the end of the thing and in your head, or you can do it more formally, you say, okay, I think I may have an edge here. Or you know what? I can't compete. Everyone's going to be underwriting it the same way. It's just who can pay the most, again, put it down the priority list.
Yeah, no, I mean, that's a perfect run through. And, what's interesting is I know a lot of investors, and I think a lot of and you kind of have to do this, I guess, when you get into the business, which is you're sent an OM, you throw it into your full underwriting spreadsheet and you blow 30 minutes underwriting it just to realize that there's literally no opportunity there and it's totally mispriced. But I think it is a good exercise in the beginning, specific to, well, especially if you're doing a lot of deals in a specific market in terms of you're underwriting a lot of these deals and you're receiving a lot of these deals, so that you can develop those back of the napkin checks. Because yeah, the property taxes in this state might be much lower than it is in this state, and therefore, the rents per unit as a percentage of the asking price per door may be a little bit different. But then if you underwrite 10 deals in that specific state, in this specific market, then you can start to develop a familiarity with what the relationships are, right? And it's, if you solve for the right price on enough deals, you start to develop a sense of what that should look like. And then it becomes so much easier to quickly screen deals and to quickly work through deals.
No, it's a really good point. And I see people, I've seen, whether it's someone posting something or making a comment saying, oh, I'm underwriting so many deals and nothing works. What I want to ask is, well, why are you underwriting those deals? If they don't work, they don't work. Like, I get it, if you're in a certain position and there's nothing to buy, you got to do something, right? But it is something, but you're exactly right, is I couldn't just walk into, retail properties in Minneapolis and know what the metrics are. You need to figure out what those metrics are based on your product type and where you're at.
Yeah, and I think a lot of people get hung up on the back of the napkin stuff because it's like, well, that doesn't really work in my market. Well, that specific rule of thumb that we just discussed probably doesn't, you're right, but there is a rule of thumb that does work. You just have to, you have to underwrite a handful of deals to start to develop that familiarity. Mm-hmm. Now, I do want to talk about California, specifically San Francisco, where you have experience where I don't invest in California. I don't invest in any markets that have rent control, but I am curious as to, sure, you can kind of look at some of those back in the napkin dynamics, I'm sure, if you're sent a deal in San Francisco, but I would have to imagine there's another element of underwriting that's important to evaluate as it relates to maybe doing a value add multifamily deal, for example, where, maybe there's some tenant displacement, buyouts, you have to negotiate. There's a little bit more of an underwriting process, in my opinion, I would imagine, for a deal like that than in a state that doesn't have those, maybe more landlord friendly laws like in the Southeast, Southwest. How
Mhm.
different is it in, call it, this process, for example, in San Francisco than it was maybe in Phoenix, where you were looking at these deals on behalf of the Swiss REIT? Does it change significantly, or do you follow a similar process?
Process wise, it does not change. The metrics are a little bit different. What I look at is a little bit different. The underwriting is a little different. The business plan is different. Obviously the way you have to model rents is different. And then of course it depends on where you are. San Francisco rent control is different than New York rent control. And I would not be able to today underwrite a deal in Manhattan or Brooklyn. I can learn. I probably have an easier time learning than someone who'd never done rent control, but
Yeah.
you do have to understand those nuances in order to underwrite. But the process itself is not different. But I'll give you some examples on how it's different once you get into the deal. The first one is that loss to lease is kind of the whole thing. And it's not just, oh, hey, look, the pro forma rent roll on this property is, $300,000 and the rent roll today is $200,000. Oh, there's 50% upside. That's terrific, right? That's the first thing, or one of the first things you want to look at. But then you have to look at the tenancy and understand, okay, if somebody's been there since 1975, they're probably not going to move. And so that $2,500 of loss to lease is probably worth zero. Now it's worth a little more than zero, and that's where the art comes in. And so at least what we do, and I suspect our competitors do as well, is you look at the rent roll and then you look at sort of loss to lease, and then you look at tenancy. And most tenants, and this is not just in San Francisco, but this is most places, are more likely to move in the first couple of years of tenancy. And so we try to bucket that loss to lease into kind of more recent turnovers and longer term turnovers, or longer term tenants, excuse me. And then you got to say, okay, now we have to assume turnovers. So it's very different than underwriting, where there's no rent control, because you can bring to market whenever you want. And then maybe you have a ratchet where if there is loss to lease, you don't do it in 1 year because you'll empty the building. And, there's some nuance around that. But this is like the whole thing. So you have to go unit by unit and try to say, okay, do I think this unit will turn over? Yes or no? And when do I think they'll turn over? What month? That's sort of the most granular way to do it. Now, again, if you're underwriting a 75 unit building, that'll take you forever. And so there are ways to sort of batch it up and say, okay, for tenants who moved in the last 5 years, we're going to underwrite that half of them turn over at some point in the first 3 years. And so there are ways to do it, but that is sort of the biggest difference in terms of how to underwrite the two. And the other one, which is kind of nuanced, is there's a lot of important distinctions between the different types of rent control. One of them is, does your rent control include vacancy control? So what that means is, once the unit is vacant, can you bring the unit to market? Or, as it is in many parts of New York, can you only increase the rent a certain amount, usually as defined by a percentage of the capital improvements you put into that unit? Totally different calculus. And again, we'll underwrite totally differently. And so you sort of have to, behind the scenes, have whatever you think the maximum allowable rent increase will be any given year. In San Francisco, over the last 20 years, the average is about 2%. And so you can sort of, book that every year. And then behind that, you have a pro forma rent growth and say, okay, I think the market's going to grow an average of 3% or 2% or 4%, whatever you want to underwrite, so that when a unit turns over in year 5, behind the scenes, you can accumulate that rent growth and then apply that to whatever you think the market rent will be at that time. So those sort of mechanical changes, you'll have to make. But those are the main things. I mean, I would say that, there's a lot of other elements. One thing I actually really like about rent control markets is that there's sort of, you mentioned downside protection earlier. There's sort of an embedded downside protection that you could have, if you have below market leases, market can go up or down. Those units are just going to keep chugging their way up. And if you happen to get a turnover, that's upside. So there is some baked in downside protection. You should never blow up on a San Francisco apartment deal. Like these guys who are blowing up, and I'll knock on wood because we haven't blown up yet on any of our deals. You just absolutely should not. Like if you blow up in San Francisco, it's because you're taking reckless leverage or you made some other mistake and look, stuff happens. But I mean, I know that the guys who are blowing up, they took out a lot of debt. But that's one thing I really like about the market. I think there's limited downside. Tenants also pay. I mean, we went from in San Francisco from 2010 till 2018 when I was more directly involved in managing those assets. I think we had one instance of a tenant not paying. And it was a situation where they had moved out, they were illegally subletting, the subtenant left, they didn't want to pay the rent. And it's the only time we ever had to evict a tenant, and we won. I mean, there was no argument. I mean, San Francisco, through all of COVID, we didn't, other than voluntary rent concessions that we made in our portfolio, we didn't lose a penny on rent. And so totally different story. In Oakland, for example, I mean, I know other markets got hit pretty hard. So it's a pain. There's regulatory risk. There's a whole bunch of other stuff. There's capital improvement pass-throughs. There's all these other little nuances. But the other thing I would say is it's a barrier to entry. A lot of people like yourself, because it sounds like you're probably not a masochist, don't want to touch California. You don't want to rent control for totally justifiable reasons. But that's fine. You know what? Like that's more room for people who are willing to go through the brain damage of getting up the curve to play. And it's a small community of people, and we sort of commiserate and having to deal with that stuff.
Yeah, and well, I think, and I was going to mention this, and you just rounded out your thought with it, but there are a lot of people that just make broad-based assumptions where it's like it's hard, or you can't, or it's challenging to make money in name any of these markets: Los Angeles, San Francisco, New York City, whatever the city is that has any varying level of rent control legislation, or even if you just take Boston, for example, or Massachusetts, right? We don't have rent control, but it's an extremely tenant-friendly state, right? So there are some challenges that come with that as well. And I think people just like to say, oh, you can't really make money there, or it's too challenging to make money there. And maybe it's a little bit more challenging, but as you just described, it's a barrier. And I think the investors are the groups who develop a really deep understanding of how to maximize the potential of a building and to efficiently work through a value add business plan, create significant value for themselves because they've developed that skill. And it's, I think, asset management in a call it, a quote unquote middle of the road market as it relates to legislation, maybe any of these Midwestern, Southeastern, Southwestern markets. You got to be good at construction, you got to be good at leasing, and you got to be good at property management, right? And that's pretty much it. If you're good at those three, you're going to do a very good job at asset management. But in these states, you also have to be very, very good at understanding the dynamics of how to maximize the deal as it relates to the challenges that can come with the legislative component. But if you get really good at that, then I'm sure there's all kinds of opportunity. And I think you ran through it in a very interesting way as it relates to defining the likelihood of individuals leaving and how you model that. That's interesting. That's not something I've ever thought about or talked about with somebody really on the show, because a lot of the people that I have on don't, everybody's doing deals in the Southeast, Southwest. That's what it seems like. And then the people that aren't are doing deals in the Midwest, where it's a little bit easier. But
it's funny, actually, you have to develop a different set of sort of skills and observations. You're walking through a unit, for example, and you're not just looking for deferred maintenance. You're looking at pictures on the fridge. You're looking at, does this person really feel like they're living deeply in this unit, and all this other stuff, and then sort of back in quote unquote back in the day, sort of in the last cycle, tenant buyouts were a really big thing. San Francisco then sort of put the kibosh on that and put some legislation that makes it still totally legal, but more difficult. And people kind of got wind of it. And so there's a little bit more headline risk there, but that's the other element. You got to go in and say, okay, not only what do I think the chances of this person moving are, but then do I think that they would actually take a buyout? Because we did a number of those, and we also took a different approach. Most people go in there and they basically, if you're a tenant and so-and-so backed by Wall Street firm takes over your building, you get a letter from the attorney saying, here's your buyout offer. I would go with the owner of our property management company. We go sit in the person's living room, talk to them, and deliver them a physical buyout offer and say, look, here you go. Here's the number. Here's how we came up with it. It has nothing to do with you or your situation. It's just based on the numbers. If you want to take it and do something with that money, fantastic. If not, no problem. We will treat you like any other tenant in the apartment, and what things in your apartment are broken, and what can we do to fix them. And we were genuine in that, and I'd say 9 times out of 10 it worked. There was not 100% of the time, but you definitely get yourself into some interesting situations, and no matter how good you think you get at predicting whether somebody would take a deal, you're going to get surprised. So the
Yeah.
most interesting and sort of the best, I would call win-win deals, were ones we never could have predicted.
I feel like that's usually the case just in general with many deals, period. But it's so interesting. And for example, like when we're looking at deals, we would prefer to pursue deals that have larger bedroom counts, and we more aggressively pursue deals that have a higher average bedroom count per unit because we're typically getting either roommates or families, and it's just a longer average length of stay for twos and threes and four bed units comparatively to studios and ones, which are a little bit more transient. And it's like I would imagine almost that it's the inverse in terms of if you're looking at a rent control deal and you got a bunch of studios and ones, well, maybe you got a single guy who's just passing through town and he's going to get a job and move out of town, or he's going to move in with his wife, girlfriend, they have a kid, they need more space, versus larger bedroom counts where that's probably a stickier tenant, right? It's interesting
exactly
the mechanisms I would imagine as it relates to how you actually evaluate those opportunities.
Yeah, for sure.
But let's talk about. I'm going to switch gears here a little bit. Let's talk about kind of the framework for a great fundraising pitch. And you obviously have plenty of experience being on the receiving end of these, specifically from brokers on the acquisition side, right? I think it's oftentimes a broker's pitch as it relates to marketing a deal for sale is there's a lot of overlap in the Venn diagram as it relates to how you actually go out there and raise capital to fund a deal that you have under contract and that you're trying to close. But in general, let's talk about how you view kind of the framework of it, and then maybe we get into some specifics of what makes a great pitch when you're going out there and raising capital.
Sure. Yeah, and I would say that there's a few ways I would answer it. The first is understanding your audience. So the pitch has got to be tailored if you're going after, as you said, retail investors, individuals who may not be super savvy in real estate, and they want to write a $50,000 or $100,000 check. That's one set of language, for example, that you may use. You may focus on one thing versus another. If you're going after, a family office, that's another story. Or as opposed to going after, trying to raise funds and partner with an institution, totally different thing. And I've run the gamut on, we've had investments as small as, $5,000 into deals, and, have sat in front of and successfully with my partners, partnered with $1 billion institutions. And so it's kind of runs a gamut. The way I think about it though, is the same for everyone. It's storytelling. It's got to be real. So it's not fairy tales, but it's storytelling. People resonate to stories. It's nice to say that people are data driven and this and that, but ultimately what resonates and what's memorable with an investor is a compelling story. And what I find to be a compelling story and has worked for me is I start with a macro thesis up at the top. The fund we raised in 2011 was called Millennial Capital. It was Millennial Capital because at the time, not everyone had heard of the millennials who wanted to, move to urban areas and live close to where they worked and live near bars and cafes and transit and walkability and all that stuff. It was happening, but it wasn't sort of in the headline. So that was the macro story. And then what we would say is, okay, here's the macro story, and here's how it's playing out at the street level. And this is what I say, look, we're seeing rents in the Mission District in San Francisco, are really strong because there's BART that you can get downtown. There's the tech shuttles that go down to Silicon Valley. And so this is how that macro trend is playing out at the local level. And then you layer on the property and say, okay, now this is how this property in this location with this business plan at this price capitalize on the macro trend that is playing out at the ground level. And that's sort of the story of the deal. And we always try to structure it in that same way. And then the last piece is, okay, and well, why are we the group to execute that strategy? We're honest, we're trustworthy, we have the experience, we have the network, whatever it is, our particular secret sauce may be, that goes into a huge part of it. Especially, and I would find that even all the way up to institutions, I have to give them credit in this, that ultimately your investor is betting on you. Yeah, they're going to know the deal, and the more sophisticated they are, they're going to be able to evaluate the deal and maybe tell you your rents are too high, your cap rate's too high, too low, or whatever it is. But ultimately, they're going to trust you to execute. And so while you're in that meeting or while you're writing that deck, the more genuine you can be, as we talked about leverage earlier, the more you can say, look, we have a belief on leverage, and that is we should be conservative and deploy it carefully. And we understand that it's going to ding our returns, and that's fine. Those little elements that you can include to say that you're going to, jump in front of a train for your investors, that will resonate whether your investors are big or small. And ultimately, like I said, they're going to bet on you. And so the more that you as an honest, reliable person can come through those materials, the better.
Yeah, 100%. No, and I think that framework is really sound. I mean, in our business, when we do a webinar to raise capital for a deal that we have in a contract, we're always starting, Google Maps. This is why this specific submarket is well located. Zoom out. This is the general area. These are some of the trends in the overall area. And then the other thing too is I feel like the deal story is critical as well. How did this actual deal come to be? What's the story with like the seller? Is this an off-market deal that you sourced direct to seller, in some other in a fashion to where you didn't compete with other buyers? Why are they selling? Why are they taking this price that we're going to pitch you on why it's compelling relative to where other properties are trading? So it's like story of the market, story of the deal, and then story of why you're the group to execute on the business plan. It is funny how that's what it just comes back to. It's all of the data is important, but that's almost, you haven't really earned the right to analyze that data as an LP until you've bought into the story as it relates to how the deal came to be and why it, as you mentioned, I like the way you put it, macro thesis, how what's happening at the local level plays into that and why this deal also fits into that. I think it's a great framework to conceptually come back to when building out a deck.
It's a really good point on the seller situation too. I'm glad you mentioned that, because that is, for example, when I'm talking to a broker about a deal, if it's not my first question, it's my second question. Tell me about the seller. What's their situation? Yeah. And you go from there. So yeah, it's a great point that's a really important piece to the story.
I'm going to put you on the spot here a little bit. No one's going to come back to this in a year and really hold you to your answer. I don't think. Maybe somebody will if they're if you give them the wrong one and they're a little upset, but I can't imagine they would. But as somebody who had real insight into what was happening 07, 08 into the early 2010s, and you obviously saw the blow up as it relates to the GFC, and then you started getting in and actually buying assets. I think if you go on Twitter, or you go online, or you look at any of the large news publications, why 2024 is going to be worse than 2008, why this cycle is going to be worse. Obviously, the media is incentivized to get clicks, right? So they're going to say whatever they say to get somebody to open their article. But I think there are a lot of folks that have this perception that we've reached the top, and pricing has been coming down the last couple of years anyways as it relates to just rates going up, and more so in some markets than others for sure. And it's, real estate is obviously micro in terms of what's actually occurring on the ground. But what is your opinion on what's happening at the moment as it relates to rates shut up? They might be coming back down a little bit. Fed says they're going to cut rates kind of throughout the rest of this year. But do you have an opinion or a sense of where you feel, call it let's try to confine it to multifamily, I guess, as best we can. And obviously you're in a different market in San Francisco than a lot of other folks that are listening to this podcast. But compare and contrast what's happening in August of 2024 to what you saw happening back in 2008, 2009, 2010.
Sure. So the other thing that I enjoy doing in my spare time is I enjoy writing. And so I'll take a slight detour and I'll come back around. But one of the other things that I did when we were getting our business off the ground in 08 or 09 is I did some financial journalism. And so my job every day was to wake up and write about the biggest story in finance, which on any given day, any of the headlines would have been the biggest story of a month. So it was a wild time to be doing that. But I really remember Sunday night when Bear Stearns went down. I remember watching it on CNBC and saying, man, I got to wake up tomorrow morning and write about this. And so that was, having sat on the desk and we were starting the business, it was a very kind of unique personal experience to be going through that, even though it was, awful for a whole bunch of different reasons. The reason I bring that up is because actually I wrote about that exact question a few months ago. And I don't think that my sense is that people who think that this is GFC2 are just wrong. Some of the reasons are that at the time, the volume of assets, both real assets and derivatives, that were impacted by subprime collapsing, and the extent to which the securitization models had broken was so dramatic, and the counterparty risk was so unknown that it was just a tremendous amount of uncertainty rippling through markets, and like institutions were just getting taken out every couple of months. So could that happen in the future? Sure, it can always happen. Do I think real estate is going to be the cause of that? No, I think there's other more systemic risks, excuse me, than than real estate. So I think that's one. The other thing that we didn't have in '07 and '08 that is easy to forget about is we really didn't have the Fed put at that time. It was Bernanke who came in along with Treasury in 2008 when they put the TARP in place, Troubled Asset Relief Plan, I believe it was. That was what actually stopped the free fall. In '08, things were absolutely collapsing, and when they put TARP in, I want to say it was fall of '08. When they said, "Hey, we're going to come in with whatever it was, $700 billion to buy all these troubled assets," that sort of put a floor in things, and it still kind of shook out. And that was when Bernanke and the Fed sort of came in, and you have to apologize. I found my tinfoil hat that I've put on now. So, but you asked a question. So,
I want to hear it. Let's get into it.
There you go. So that was when they came in and started kind of fiddling around with all these other monetary policy techniques that hadn't really been tried before. They had the discount window. They had all these things that they were trying. I mean, Bernanke literally was a PhD on the Great Depression, if I'm not mistaken. That's what he read. He either wrote his dissertation on, or that was his expertise. And so he sort of wrote the rule book, and we can all criticize him for different things, but he was basically fixing the plane as it was flying, right? He was figuring it out. And so, but now that rule book is written. So, markets start to crash. Fed wants to, come in, they drop rates. They have all these different mechanisms. They buy mortgage-backed securities. They have all these different ways they can come in and sort of triage. And the market knows that. And so people are going to be less prone to just dump assets. The other big difference is back then, the way the banks dealt with these assets that they were taking back. First of all, they were much more aggressive on foreclosures than they are now. Right now, I mean, there was a little bit of loan mod going on in sort of the residential world, but not nearly as much as the old extend and pretend is happening now. So those banks were just dumping these assets. I mean, we saw tapes of hundreds of properties, smatterings of houses, office buildings, retail centers, vacant land, just being dumped onto the market. And that, banks just didn't care. They were not set up to handle these properties that they own, and they just unloaded it all. And so as a result, and the markets were, the buyer markets were frozen. No one was getting financing. And so things just, kept falling and falling and falling. Totally different story now. I mean, I can speak to San Francisco, which is ahead of the curve in terms of distress in multifamily. I believe something like 3,000 or 3,500 units, which for San Francisco was a lot, have been taken back by banks in the past 12 or 18 months. None of that's hit the market again for resale, much to my chagrin, because I'd love to be bidding on it. But the asset managers who are hired to do that are hired to manage the asset. They're not hired to unload it. They're hired to maximize it, stabilize it, add a little value, and then the lender is going to say, okay, now you can sell them off bit by bit. And so the market has learned how to deal with these problems that I think is going to make it a lot less likely that you have some sort of cataclysmic problem, again, sparked by real estate.
Mm-hmm.
U.S. federal debt, sovereign debt, geopolitical problems. There's other things that could tip us into something bad financial crisis-wise, but I don't think real estate's it's just not big enough. I mean, you look at the amount of bad office debt, for example, banks have on their balance sheets. It's just not enough to move the needle. It's not nearly enough.
Yeah. First of all, that was incredibly insightful. And this is just a sense I've got because I wasn't in the business back then. I started learning about real estate and becoming educated back in 2014. First deal was 2016. So really, we'd come out of a lot of those challenges by then. But even just in the time that I've been in it in the last 8 years, being in real estate, specifically rental real estate, multifamily, income producing real estate, like the average skill set, I think, of a multifamily investor, if I'm just going to speak specifically to multifamily, I think it's just increased exponentially as it relates to there is so much content out there, whether it's podcasts or YouTube or paid education of some kind, social media, whatever. As it relates to just being good at operating real estate, there's just so much more resources. It's much harder to be bad at it than it was back in 2016. I remember people getting into it back then, and tech was still kind of rudimentary, had some property management systems, but a viable business plan back then was like buying a place and just letting tenants pay rent online or enabling to do that. And that's now the tech is so good and there's so much infrastructure on successful operations specific to multifamily. I have to imagine that is a significant change from what was occurring back in 2006 through 2010, where there was just significantly more variance as it related to the skill set of an average multifamily operator, right? There's probably had some bad ones and some great ones, everything in between. But now it's much more tight as it relates to, I think, just the quality of operations. And there's obviously still terrible operators out there doing deals, but as a percentage of the overall multifamily investor landscape, they're much smaller. At least that's been my anecdotal sense over the last 8 years. And I think at some point that has to start mitigating some of the fundamental operational distress that could occur as it relates to just collecting rents, getting bills paid, keeping units full, and just driving NOI. And I feel like, obviously there was all kinds, it was driven by debt back in the GFC, but it was probably compounded to a sense by the fact that you had operators that weren't skilled either. And I feel like that's a different place. Do you think I'm crazy for saying that, or for kind of making that assessment? I don't know if you've noticed the same thing or not, and I'm curious on your take.
No, I think it's a good point. I mean, you to be honest, you would know better than I do because you're closer to most of the operators, or I guess you're more standard operator.
Yeah.
I'd say, San Francisco is a bit of a different beast, and it's still super inefficient, which we appreciate. But no, I think it makes sense that, I mean, the properties that were being bought back then and were, 40% occupied, 50% occupied, and there were so many different factors going in there that, how do you value that, right? So here it's like, okay, rents are going to dip 10%, 50%, maybe 20%. Like, that would break a lot of models, but there's a lot more resilience, as you said, in the operational systems to make that happen. So I think it's probably reasonable, but again, you'd probably have a better sense than me on.
This is me just brainstorming live here. Is really what that is.
Yeah, fair enough.
A thought I'm having as it relates to, like,
I came up with a crossword puzzle analogy, so we're allowed to spitball, right?
Yeah, exactly. And a lot of it is supply oriented as well. Obviously, the supply dynamics were very different back then than they are now. Yes. We operate in the Northeast where this market being supply constrained is part of the biggest component of our macro thesis for buying deals up here. It's any level of population. We buy a lot of deals in New Hampshire within an hour of Boston. Any population growth will not, or I should say, will exceed supply growth. Any supply growth will not match population growth, which is a different dynamic than I think a lot of what was driving some of that distress back then, and also what's driving some of the distress now in other markets throughout the country, whether it's Phoenix or Austin or Tampa or some of these more high growth, high supply areas. Whole nother topic, and I want to wrap up before we come up on our time here. But this has been incredibly valuable. I know we dove deep into a lot of great subjects, and I really appreciate your time. If folks who are listening want to get in touch with you, where can they reach out to you? Where can they learn more about you?
Sure. I mean, I have my little one-page website at millfork.com. So MILLFORK. I'm unfortunately not open for business only because I'm at my max capacity with clients, but I did start posting on X, formerly Twitter, about 6 months ago. It's at CRE Deal Junkie. So I probably spend more time on there than I should, but it's been great. That's how you and I connected, and I have to say that I've learned a tremendous amount from the folks on there. There's a wealth of knowledge on there. Now, it's not enough to go from zero to do your own deal. But every time I think I know a lot about a subject, there's somebody on there who knows more than I do. And so I think if you're humble and willing to not be a troll and just kind of get into some productive conversations, it's a really great place to actually learn. And even if you're just a voyeur, it's totally reasonable. I did also, I don't promote it, but I have a Substack, same CRE Deal Junkie. I write once a week. It's usually about multifamily. Sometimes it's about macro, sometimes it's about my own experience. Every once in a while it's a little random, but that's sort of a hobby of mine that helps process my thoughts, and I enjoy doing it. So that's where you can find me.
Love it. I'm gonna have to go subscribe to that. And for the audience out here, go follow Andrew on Twitter. He's consistently posting some pretty insightful content. I think I found your account from a thread you put out as it relates to LPs changing their focus and having, like, kind of, you're okay with 3 different changes in focus or something along those lines. Anyways, it was incredibly insightful. And I may be misremembering the exact specifics, but because you're posting pretty frequently on there, and this was a while ago, but no, I really enjoy everything you put out. It's a great read. And I'll be sure to link all of this stuff in the show notes as well, so everybody can easily go find it. But thanks again for taking the time, man. This has been incredibly fun.
Absolutely, Axel. And if you want to do it again, happy to come back.